As we move into the second half of the year, we use the opportunity to review the economic scenario we presented to you back 7 months ago at the end of last year. Did our expectation of a broad-based recovery materialize? Is it still valid? How to position portfolio for the second half? First of all, it is a healthy exercise, sometimes sobering, to compare our forecast with reality. All in all, we would say that the recovery is broadly on track, even though it is less dynamic and less synchronized than we initially expected. Why? The US had a very poor first quarter, and economic growth in emerging markets has been revised downward. On the positive side, inflation came below our expectations, which allowed central banks to maintain their dovish bias in their communication. Most recently, the ECB has surprised the market by implementing measures to boost lending in the Eurozone and minimize the risk of deflation. On the negative side, however, it is fair to say that geopolitical risks have increased substantially during the first half of the year. First of all, Ukraine, but most importantly, Iraq. Iraq is the second largest oil producer within OPEC, and we can put a question mark behind the ambitious production target of the country in the longer run. A surge in the oil price would certainly threaten our central scenario. Is it enough to change our central scenario for a broad-based recovery? The answer is no. We even think, without a surge in the oil price, that the recovery will get even broader in the second half of the year, because it is increasingly visible that the US suffered in the first quarter from a one-off weather-related event, deep winter. And we start to see some stabilization in emerging markets. And last but not least, the recent data in China showed that the government measures taken to offset the weakness in property market start to show some positive effect. In that environment, we remain positive in favor of risky assets and equity markets. Indeed, the structural environment remains supportive. We have accommodative monetary policy, decent recovery, and robust cooperating earnings. However, such an environment, at the end of the day, down the road, always lead to some excessive valuation. And indeed, in some corners, we see the first signs of exuberance. For example, record mergers and acquisitions activity is the start of a bit of animal spirit coming back. But all in all, for the time being, we stick to our overweight in risky assets while paying attention to valuation and a turn in monetary policy. Let's not forget, the Federal Reserve will terminate, most likely, its quantitative easing program before the end of the year, in the autumn. And without this liquidity tailwind, it will be harder for equity markets to achieve gains without true earnings growth for companies. Given the extremely low level of volatility, we also advise clients to spend some insurance premium to buy put options to protect the downside in portfolios. And currently, the price of such a protection is very attractive. Thanks for your attention.